Good morning, folks. My name's Robert Coulter. I'm the General Manager for Partnerships here at the AFA, and I'm delighted to be hosting and introducing today's webinar titled COVID-19 Stimulus Packages Repacked. The continuing COVID-19 pandemic has led to several changes to financial support measures and introduced new initiatives to drive growth in certain sectors, with interest once again increasing on what these changes will mean. I'm delighted to welcome back Adam Crabb from Zurich's Risk Strategy Specialist team in his second webinar event, this time focusing on how the various schemes have changed, what new initiatives have been unveiled, and most importantly, what advice opportunities exist from the amended stimulus measures. Adam will be known to many people on this call. Adam Crabb has over 25 years of financial services experience encompassing retail banking and financial planning. He joined Zurich in March 2018 following 5 years as a senior analyst for insurance product research, a role in which he was instrumental in developing a framework for approved product list construction, performed comprehensive due diligence on insurance products, and helped in the selection of products and strategies that have assisted financial advisors achieve best interest outcomes for their clients. Adam is a frequent presenter at conferences and professional development days and has lectured for the Securities Institute and Kaplan Professional. Before we begin, I'd just like to cover off a couple of webinar housekeeping matters. Today's webinar will attract one CPD hour, which will be sent out. That certificate will be sent out to you within the next week. We will be taking, or Adam will be taking questions, so feel free to ask those, but please use the Zoom Q&A feature, not the chat feature, as you can see in the diagram below. This is, of course, being recorded, and you can obtain a copy of that recording, or you can view it on the AFA website when this will go up later this afternoon. Adam, welcome back. I'm really looking forward to hearing your presentation. I know that this is really a moving feast, and even just talking to you this morning, you were talking about how much movement and how quickly you've had to adapt in updating this presentation. So thank you from the team here at the AFA for putting this important information together to help our members. Adam, over to you.
Thanks very much, Rob, and thanks again for the opportunity to sort of cover this topic. And as you say, it certainly is very much a movable feast. Some of the announcements that we're going to cover today were as at just Friday of last week, and in fact some were researched just only yesterday. So look, as you say, very much a moving feast, and I think very much a topical area of discussion that if your clients are not already talking about these sorts of things with you and your practice broadly, I think it is only a matter of time. So today is all about a repacking of the COVID-19 stimulus measures. So it is kind of the second session that we're covering in terms of the financial aspect. Now, one of the things I do want to point out, given the ever-moving nature of what we're covering today, today's session is based on announcements and research as at August, so as at today. So any future measures, any financial packages, even more amendments are likely to occur down the track. So it's probably just noteworthy that this is very much a moment in time type piece. Now, the other thing is certain things that we may talk about today may not yet be covered as part of law, so are still subject to change. So please be mindful of that. But one of the things I will be doing in this session, as I did last time, is that at the end of the session, I will give you some details on accessing some tools and other resources that are going to be available for you and also for your clients. Now, in terms of the COVID-19 pandemic, look, it's certainly been well documented almost on a daily basis. It's almost a bit of an overload. But what I sort of wanted to focus on were just some of the changes and what they do mean down to a client level. And I think when we look back, certainly these stimulus packages really have been quite a benefit to many Australians, even to the broader economy. And I think the All Ords has strengthened from its low back in March, rising around 35% over the following 4 months, but still well short today of the February 2020 peak that we had. So these packages really have played a very critical role in managing the financial impact. And it's been evident not really just through the income payments, things like JobKeeper, or even access to lump sum, say via super, but we've seen some real uptake in things like the temporary loan repayment deferrals. Now, as at June, if you're not aware, it's sitting at around $274 billion, roughly 10% of the total loans in Australia. So it really has been quite sizable. So as this period in this pandemic does seem to be extending, there are so many key changes and impacts that are likely to be occurring. Things like eligibility, reduction in payments, and even changes in terms of extensions to benefit periods. So let's start first looking at this from an individual, from a self-employed, and also from a business level. And the first thing we're going to talk about are the coronavirus supplement. Now, as you may know from our first session, this was a temporary supplement, originally launched as a fortnightly top-up to existing income support payments, and it was initially pegged at that $550 amount, so quite a generous uplift in terms of people's takeaway income. Now, from September 25, the coronavirus supplement will continue for longer than first suggested, but it will be at a discounted rate. So it is going to be dropping to $250 a fortnight. And at this stage, the extension will now be up until the end of this year, so much longer than was first anticipated. Now, the benefit will continue to be paid both for new and for existing recipients of certain income support measures. So things like youth allowance, JobSeeker payment, parenting payment, AusStudy, ABStudy. So these can all be accessed through these payment mechanisms. Now, to get access to the supplement, it can be done in person, online, or via the phone. Now, there is also a way that is a way that's changing in getting access to these benefits, and it's certainly something we'll cover off on shortly. As you may know, though, JobSeeker is now the main income support being offered. Now, it's the main income support for people looking for work or those who can't work due to illness or accident. Now, the base rates that you can see here on screen, these are effective from May. And as you can see, they do vary in line with whether there are children or dependents, whether someone's single or indeed partnered. So these amounts that you see here, they do exclude the coronavirus supplement. So obviously that means that there will be an uplift by these amounts upwards of that $550, at least until September 24. So keeping in mind from September 25 is when they will actually reduce to $250. So as an example, a single JobKeeper recipient, someone that's got no dependents, no kids, they'll be receiving just over $1,115 a fortnight. That's with the full coronavirus supplement, and this will fall from late September to just over $815 a fortnight. So why we've included this information here, folks, is that there are going to be some alterations to the way in which people will come to access JobSeeker and subsequently the coronavirus supplement. And one of the ways in which it's changing involves the waiting periods. Now, a number of waiting periods have been extended out to the end of this year. So previously there was some relief that was originally designed for the entire coronavirus supplement period, where clients could continue to enjoy, I suppose, a real reprieve from many of these. There's the liquid assets waiting period and also asset testing. But from September 25, this is actually going to stop. So these will each be reinstated. So clients, their liquid assets will again start to be considered. So this could indeed add many weeks or even months before a client becomes eligible to receive many of these government support benefits. Now, if you do have clients that may be adversely impacted by other waiting periods, so this could include things like the newly or new arrived waiting period, the 1 week ordinary waiting period, there is some good news here in that these are not actually affected, so they'll continue to be waived right up until December 31 at this stage. Now, the requirements for job seekers to actively look for work, attend appointments, or even participate in activities, these were all suspended from March 24. But from August the 4th, the relaxation of the requirements have actually lapsed. So job seekers are needing to now recommence these activities. Now, this extends to all states and territories with the exception of Victorians. So many of you may have heard the Prime Minister's announcement which was last Monday, so August 3, and this was due to the heightened state-based restrictions in Victoria. So if you look at the Treasury website, even as of today, there's still no update on the Treasury income support fact sheet. But if you want to know more information, if you do have clients in Victoria that you think it will be a real valuable insight, you can actually log into the Services Australia website. The information is currently listed in there and is available. So what it shows is that Victorians will continue just with the limited obligation requirements, being able to engage with employment services providers and the like, but no penalties and no suspensions apply to Victorians. But for other states and territories, these, what they call mutual obligations, they will generally form part of the job seeker's job plan, and they will include needing to attend appointments. You'll need to start doing the searches, looking for work, applying for work, and other approved activities, things like voluntary work and training. They're all fine to include. Now, appointments don't need to be held in person. If people are worried about that, they don't need to be done in person. They can be done over the phone or online. Now, while there was previously no payment suspensions or penalties for failing to comply, with these changes, this will no longer be the case. So from August 4, job seeker payments can be cancelled, and they can be cancelled for a period of up to 4 weeks if people refuse suitable work without a reasonable excuse. So if I think about from an advice consideration here, there are still some opportunities for some clients to be exempt from these mutual obligations. So if you've got clients that are still impacted by, say, the bushfires that we suffered from earlier in the year, or even other disasters at their home, there's an opportunity here for you to reach out and really assist these clients to apply for an exemption due to these specific circumstances. Now, equally, clients that are impacted by things like domestic violence, or if there's been a crisis in their home, such as a death of a family member, or even the short-term care duties for an adult or child, these can also be acceptable reasons. Now, those in home isolation because of COVID-19, they can also be granted an exemption for a period of up to 2 weeks. And this can also be extended into situations where someone may be providing care for, say, a young child, and even where the child's childcare centre has actually been closed, so the children can't attend. So these are some opportunities that might assist you in providing some of these job seekers with that extended relief. Now, the other thing which you may not be aware of, or many of you, is this demerit point system that actually works. So there is a demerit point system that applies for non-compliance with the mutual obligation requirements. Now, if you're not familiar with the system, you get or you incur 1 demerit point each time a requirement is missed. So this could be a refusal to accept a job offer. It may be a failure to start a job, or even leaving a job without a valid reason. So each demerit point that you incur lasts 6 months. And once you receive 5 demerit points in across a 6-month period, the job seeker moves into what's called the penalty zone. So where if they miss any more requirements, they're actually at risk of having their benefit cancelled. Now, the penalty zone is actually one of 3 zones that link to the job seeker's compliance status, with the others being the green zone and a warning zone. So the first penalty will see a fortnightly payment halved, so it's quite drastic. A second penalty will mean a loss of the fortnightly payment. And a third penalty really means a loss, a complete cancellation of the job seeker payment. So it's quite significant. Now, recipients need to stay in that penalty zone for 3 months, and they will return straight back into that green zone only if they've done the right thing during that 3-month period. So some of the other changes relate to means testing. So with the asset test set to recommence, along with increases to the limits to the partner income test. Now, this was from the previously reduced rate of 25 cents, which will lift up to 27 cents. Income-free limits is something else which is going to be relaxed. So this will allow for a greater level of income to be earned without impacting on someone's job seeker entitlement, which is some good news. The previous threshold, as you can see here, allowed up to $106 a fortnight, and it then fell away by 50 cents in the dollar, earning up to that $256 per fortnight amount, when the tier or the threshold again increased up to that 60 cents in the dollar. But from September 25, these will be changing. So the income-free area for both JobSeeker and Youth Allowance will rise by more than double. And as you can see there, it will double to around $300 per fortnight. And there'll be a higher income test sort of threshold, which kicks in over this fixed tier of 60 cents in the dollar. Now, the minimum age for JobSeeker applicants, that's going to stay the same at 22 years of age. But people that are younger than 22, they still need to apply via Youth Allowance. Now, as you may be able to see on screen, it's maybe a bit hard, but the bottom right-hand side there, the Youth Allowance had a higher income-free area of $143 a fortnight on the lower tier and $250 on the higher tier. But both of these amounts will actually be increasing to that same level of $300. Now, if you've got clients who are on JobSeeker and they are principal care parents, they actually have a lower income test of 40 cents in the dollar, and they're actually unaffected by the September 25 changes. So while the income test threshold has actually gone up, it's actually worth looking at how these changes will actually work in practice. So I've put together here just a quick example just to sort of illustrate this for you. So we have here a client by the name of John. So John's single, he's earning $250 worth of income, and he's currently receiving the JobSeeker entitlement. Now, under the older or current rates, John's income does exceed that lower rate tier of $106, and he exceeds it by $144. So this amount is multiplied by that 50 cents in the dollar, or works out to be half, and this gives us the benefit reduction amount in the JobSeeker payment by about $72. So it reduces it down to just over $493 per fortnight. When we add in, though, the value of the coronavirus supplement, the total entitlement is just over that $1,043 per fortnight. Now, once the changes occur, and if we assume that there's not going to be any change to John's $250 income or to the base rate of the JobSeeker payment, he won't actually exceed that tier. So his income will be below that new $300 tier. So it will mean that there'll be no change to his base rate, which is some good news. What will change, though, is the level of the coronavirus supplement. So obviously that's going to be something which will impact. And as we know, it's dropping from $550 down to $250. So despite the fact that this income tier sits nicely under or nicely outside the amount of money he's earning, John's income, as you can see, will be just over $815. So it will be just over 20% less than he's getting currently. So it will be a significant change. Now, you may encounter clients that are likely to be impacted certainly by this moving forward. And in fact, the government's advised that income support recipients that are earning above their income test cutoff point and therefore on a nil rate of income support are able to continue to receive their concession card. And in fact, they've also said, the government said that they can return seamlessly to income support if their earnings then reduce below the cutoff, which I suppose at least is some good news. Now, if we move away from JobSeeker and have a look at JobKeeper, now this is certainly a scheme which has undergone some major changes. And this is probably one that's likely to drive significant questions from many of your clients and customers. So government data actually showed that at the end of May, there were over 906,000 businesses and not-for-profits applications processed for the JobKeeper payment. So it's been incredibly popular. Over 1 in 3 of these businesses were based in New South Wales. Just over 1 in 4 were Victoria, almost 1 in 5 in Queensland, and around 1 in 10 in WA. Now, you'd be well aware the current rate is $1,500 per fortnight, and that rate will continue, but only in the current rate and in its current form until September 27, which is when the JobKeeper payment is set to drop. So there is some good news. The benefit period is actually extending, and it's extending out by a further 6 months. And this will be up until 28th of March of next year, at least at this stage. Now, before we look at these changes at an employee and at a recipient level, with regards to business eligibility, there has also been some updates here. So while the percentage-based rules remain unchanged, what has changed is that there is an additional turnover test that these businesses are going to need to adhere to. So just, I suppose, to recap, the businesses with a turnover of less than $1 billion, the turnover reduction needs to be more than 30%. And if you've got businesses with a turnover of over $1 billion, the reduction needs to be by half, so it's 50%. Charities, not-for-profits, they only need to have experienced a drop of 15% or more. So under the amendments, eligible businesses will need to once again have to demonstrate their actual GST turnover has significantly fallen, and this must be done for both of the extension periods. So this is going to be September 28th to January 3 for the first period, and the second period being January 4 to March 28th next year. So this will mean that a business will need to show that both the September quarter 2020, so that's July, August, and September this year, and the December quarter, so October, November, December, have significant falls compared with the same quarters in 2019. So both quarters need to have suffered the fall to continue to qualify. Now, for businesses that may struggle to compare the actual year-on-year quarters, what the tax office has done is allowed for some discretion. So if you feel that businesses, maybe even your own business, could be impacted, it's worthwhile applying via the turnover test for even the possibility of an exemption to some of those levels. Now, recent announcements were made for certain Victorian workers in the form of a $1,500 payment. Now, we'll cover off on this shortly because it's not specifically a JobKeeper payment, but it's certainly the same rate. But it's actually a disaster recovery payment, so we'll have a look at that in a moment. So for JobKeeper eligibility, it's certainly one that's likely to generate some interest from your clients. So let's just have a look at that for a moment. So previously, employees could be full-time, they could be part-time, fixed-term contractors, and even casual workers, as long as they'd been working on a, what was the terminology they used, regular and systematic basis for at least 12 months. And this was as at March the 1st of this year. Now, one of the very recent changes, in fact, only last Friday, August 7th, there was a shift in the eligibility date. So it's moving from March 1st to July 1st, meaning that those employees who are currently employed and were employed as at 1 July are eligible in the extension period, which is some good news. So for example, the casual test, that now requires a worker to have been working on that same regular and systematic basis, but over the period prior to 1 July. So that's likely to capture a lot more people under the scheme. So for the most part, the definition of eligible employees remains the same, certainly since the initial JobKeeper announcement. But one of the changes that the government did make affected many young JobKeeper applicants and recipients, specifically those aged 16 or 17 years of age. So this is something which they kind of made a change in terms of how much was being received. So if you cast your mind back, when the scheme first launched, these younger workers were entitled to the full $1,500 payment as long as they met that other eligibility criteria, so being a part-time worker, casual workers with at least that 12 months to March the 1st. Now, in May, the government amended the rules where these 16 or 17-year-olds needed to either be independent or not undertaking full-time study. So otherwise, if they're still at school, say in years 11 and 12, it meant they were no longer eligible. But because several of these payments had actually been already made to many of these teenagers, the government actually stated that these 16 or 17-year-olds that met the eligibility criteria who weren't in fact independent but were studying full-time, they would actually remain eligible. But just for that period between March the 1st and May 11. So if there are children of your current clients at that age, or perhaps children or even grandchildren of your own, and they were working even casually during that period, it's worth ensuring that they, if they were eligible, that those payments were received even just across that sort of 10-week period. Now, other than these changes to younger workers, the amount of hours is set to change, and this is really important, and this is regardless of your client's age. So the extended JobKeeper criteria now makes reference to 4 weekly pay periods, and this is prior to March 1st. So where eligible employees who are working on average at least 20 hours per week across these 4 weekly pay periods are eligible to continue to receive this full JobKeeper payment, but the full rate will in fact drop and it'll drop by 20% to $1,200 from September 28, being the start of the first extension period. So for those workers who don't meet this new 20-hour per week work minimum, they will be entitled to a new and further reduced JobKeeper payment of just $750, so exactly half of what it is today. So for the second extension period coming into effect January next year, the same 20-hour work test will apply, and it will apply for the same period as it does currently. So that's that sort of February 2020 period. But this time from January 4, that rate will in fact drop again. So if people still meet that 4-week period, it'll drop from $1,200 to $1,000. But for those that don't qualify for that 20 hours, it'll drop from $750 to $650 per fortnight. And these rates will continue, at least at this stage, until March 28th of next year. Now, the other change, which you may not be aware of, affects some childcare workers. So with the resumption of the government's childcare subsidy from July 13, employees of a childcare subsidy approved service under the Family Assistance Law, and in fact sole traders, those that are operating a childcare service, they won't be eligible for the JobKeeper payment from July 20. There's also a carve out for organisations providing childcare and other services, where an employee whose duties relate principally to the delivery of childcare subsidy supported childcare, they will also not be eligible for JobKeeper from that date in July. Now, it's probably natural that you may have queries, particularly around the application of the 20-hour test. So I thought we'd have a look here at an example. So here we have a 21-year-old cafe worker. She's employed on a casual basis, and she's been working on a regular and systematic basis prior to 1 July, and has been with her employer for 2 years. So at this stage is eligible and receiving the full $1,500 JobKeeper payment. Now, with the payment extension comes the new requirement of hours worked before 1 March. So let's take a look at that. So for Hannah here, we can see that she has worked around that 20-hour per week mark, with some weeks higher and some other weeks lower. The question here is, what will Hannah's JobKeeper entitlement change to once this extension period begins? Will it drop to $1,200 or will it drop to $750? Well, if we look at her hours worked, we need to average them out over each of the 4-week period. So if we add these out together, we get 78 hours. And when you divide by 4, you actually get to 19.5 hours. So for Hannah in this example, her JobKeeper entitlement will reduce from September 28, not to $1,200, but to $750 per fortnight. And it will reduce further from January 4 to $650 a fortnight. And that'll be for that second extension period. Now, it's important to reiterate here, the change in eligibility I mentioned from March to July doesn't extend to the 20-hour test. So what this means in actuality is that while more people may be eligible for JobKeeper if they kick in from that July 1 date, because they're not going to satisfy that working in that week prior to, or those 4 weeks prior to March, they'll actually fall to the lower tier once that reduced rate kicks in. Now, it is possible that you're likely to have clients that will have differing situations. Perhaps they were in the midst of an absence from work. So let's take a look at a couple of examples with some insight into how maybe some other of your clients may be treated. So firstly, here we have a client that wasn't working and instead was providing care for a newborn child. So they were receiving an entitlement via the Dad and Partner Pay Scheme. And this was during the period prior to 1 July. And the question's been asked of you, are they entitled to JobKeeper? Well, in this situation, unfortunately, JobKeeper, it won't be available. The government has carved out recipients of parental government support, including both the Dad and Partner Pay, along with parental leave. So recipients won't be able to receive both payments. So for clients who are receiving support by way of workers' compensation, they too will be ineligible for JobKeeper, but only in instances where the workers' comp relates to a total incapacity. So if clients are working in a partial capacity, so receiving a partial workers' compensation, there is likely to be an entitlement there to the JobKeeper for those particular clients. So finally, for those clients whose employment situation has changed, so let's say they were eligible back in March, but have since had their work terminated and are now working elsewhere. So they look likely to be entitled to continue to receive JobKeeper, just so long as they were employed as at 1 July and both they and their new employer meet the eligibility criteria for a payment under the scheme. Now, in situations where the clients may have started working after 1 July, so they first start work after 1 July, because they weren't at work at 1 July, they're not going to be eligible for JobKeeper moving forward. So that's certainly something to be mindful of. Now, with the JobKeeper payment in mind, there are some state-based initiatives which I think closely match certain Australian government financial measures, and there's been so much change going on with many of the states and territories. I thought it was worth us actually having a look at many of these, particularly for clients that you may find are impacted by some of these changes. So 2 of these payments are from the Victorian state government, and given the extent of the pandemic there, I think it's worth understanding these in detail first. So the first payment in Victoria, this is this one-off $1,500 payment, and it's made if Victorian workers or their children under the age of 16 have been instructed to self-isolate or to quarantine by the Victorian Department of Health and Human Services, and this has been due to the diagnosis of COVID-19 or has been in a close contact of a confirmed case of the disease. Now, this benefit was only up until recently a state-based payment, and it was called the COVID-19 Worker Support Payment. But on August 5, it shifted to be offered at a federal level and is now known as the Pandemic Leave Disaster Payment. So the recipient for this payment must be living in Victoria and are in continuing work, but they're unable to work as a result of the stay-at-home order. They must also have used up all of their sick leave and pandemic leave entitlements, but not be receiving any form of government support, and this includes JobKeeper. So the scheme, it does extend to casual and self-employed workers, which is some good news, as well as some people as young as 17. And it also extends to certain visa holders, and this includes those on the 457 temporary skill and the 482 temporary skill shortage visa holders. Now, with the name change, you may find that there could be some confusion. So if a client asks you and says, do I get access to both the worker support payment and this pandemic leave disaster payment? They won't. It is simply the same payment, one replacing the other. Now, on July 23, the Victorian Premier also announced an extension to this scheme, and this was via a one-off $300 support payment. And it became available as soon as someone was tested and required to self-isolate and while waiting for the results of their COVID-19 test results. Now, this second payment was referred to as the test isolation payment and also applies if your client is a guardian or in fact a carer of someone else who has been tested. Now, to be eligible, they must have been likely to have worked during this isolation period and also not be receiving any income or salary during that period. And just like the pandemic leave disaster payment, need to have used up all the sick leave and carers leave and not be receiving any government income support. And this again includes that JobKeeper payment. Now, if you're looking to assist, maybe help a client claim for this benefit, they will need to provide some documentation. So this could include, it needs to include like a proof of identity. So it could be a Victorian driver's license or maybe a proof of age card. They also need to provide some evidence of employment. Now, this can include a payslip if they're just a PAYG worker, or if they're self-employed, a valid ABN number is acceptable. So looking at some of the other state and territory initiatives, there are some different schemes available, and I think will be a real help to many clients and customers that you have right across the country, or in fact, if where you're listening to me from today. So what I'll do is I'll just select one or so from each region. So in New South Wales, advice opportunities are available for investment property owners, and this is in the form of some relief in their land tax obligations. Now, it applies in situations where the tenants themselves are in financial distress, and the landlords have actually extended out and provided some rent reductions to those tenants. And it's during the period of April 1 to September 30, so that sort of 6-month period. Now, New South Wales government advice has included what is considered in their terminology financial distress. And what it includes is tenants that have had a reduction of 25% or more in their household income. In addition, the rent reduction that's being offered, it can't be a deferral. So if tenants are thinking, if landlords are thinking we can just defer this, they're not going to be eligible under this scheme. So it has to be a for real and true kind of rent reduction across that period. Now, if you're thinking, this doesn't really seem like a natural gate opener for clients, many investors may in fact be unaware that this scheme is available, and they may be in a situation where they're just not eligible for any government support. So if they've experienced a reduction in their income, I'm sure this would be a welcome result and welcome relief, certainly from an outgoings perspective. And to give you an idea of just the size of the potential saving, if you've got clients, say in this example, let's say they've got 4 investment properties and the combined land value is sitting at 2 million. Let's just say 2 of the tenants, for example, have suffered hardship from COVID-19, and as a result, the landowners halved the rent, which means obviously half the income coming in. So this will be a rent reduction for this particular client of $22,000 in lost income. So the land tax attributable to these 2 affected properties works out to just over $10,100. That's just for this year alone. But as a result of the New South Wales government relief plan, 25% of the land tax won't be payable. So it will save this client in this example just over $2,500 for this calendar year. So it's certainly something which I think is worth looking into if you've got clients in this particular situation. The other thing, just as a sort of a subset to this, is that the state government is also allowing a deferral, a 3-month deferral in land tax payments. And this includes where the 25% decrease has been applied. So applications for this benefit, if you are interested, they can be made at service.nsw.gov.au, and you just search for land tax relief and it'll come up on screen for you. If we head to Queensland, they've actually had a number of incentives on offer. One of them is a now closed job support loan scheme. And there's also been payroll tax relief in the form of refunds and also deferrals. With applications for those, actually, the deferral schemes still available up until the end of the year. But one of the incentives I wanted to highlight here is the Small Business Adaptation Grant, which is a program that helps small businesses which have been, I suppose, highly impacted by COVID-19 to continue to meet operating costs and prepare at least for the resumption of trading post the virus. Now, round 1 applications for the grant have actually closed, but round 2 are still open. They are available to regional Queenslanders, and it can be done through the Q Rider system, which is QRIDA, the QRIDA system. The government advises that the funding requests are currently sitting at 60% capacity. So there is still a window of opportunity there for clients that you may have that are affected under that particular grant. So the funding of $10,000, it can be used for a number of advice-related costs. And this includes both financial advice fees and insurance costs, which is some good news, along with a number of other expenses, and they're well listed there. So if you're wanting more information on this, if you head to business.qld.gov.au and the Small Business COVID-19 Adaptation Grant, it's on that landing page. It's about the 4th bullet point down. Tasmanians have access to a benefit not too dissimilar to what we've seen in Victoria, where they can access a one-off payment when they are required to self-isolate due to COVID-19 risk. The Pandemic Isolation Assistance Grant is based on the size of the household. And unlike Victoria, the eligibility, it doesn't rule out necessarily those on government support, which is some good news. What the Tasmanian government has stipulated is they must be classified as low-income persons. Now, this can be evidenced via a Centrelink healthcare or pensioner concession card or through genuine financial hardship. Now, if you've got clients or Tasmanians who are returned travellers and are required to quarantine and they're doing so in government provided accommodation, they won't qualify for this payment, even if they meet the other eligibility requirements. That's important to note. Now, this particular grant, it pays $250 per adult and $125 per child, and it caps out at $1,000, or the equivalent of having a household with 2 adults and 4 kids. Now, last Friday, the Tasmanian Premier did extend this criteria to casual workers. So it is, again, one of those ever-evolving situations. So if you are interested, just head to the coronavirus.tas.gov.au website, and it's currently sitting in the household section of the stimulus and support subsection of that website. For residents of South Australia who, as at July 1st, were out of work as a result of COVID-19, they will get a one-off boost of about $500 to their cost of living concession. There is a limit, though, of 1 eligible person per household. So if you've got, say, 2 clients, both of whom are on JobSeeker recipients, both living at the same address, only one of them will be eligible to receive this benefit. And look, the reason for that is it's kind of a bit of a stimulus for things like living expenses like electricity bills. From an advice perspective, for those listening with clients in South Australia, or if you're in SA yourself, applications are still available for this particular benefit, but they must be lodged by October 31. To be eligible, residents must hold an eligible concession card, such as a Commonwealth Seniors or Low Income Healthcare card, be receiving an eligible Centrelink payment, so this includes JobSeeker, or meet low income limits. Now, if you're curious as to what the low income limits are, this is them just on screen now. So it's just under $670 per fortnight for singles. Singles with dependents a bit more, $716 a fortnight, or couples, so partnered, it's sitting just under $1,230 per fortnight. If you are looking to maybe help some of your clients apply for this on their behalf, what you can do is you can email a small PDF form to your clients to complete, and it can be then submitted via email. And the email address, if you are interested, is concessions@sa.gov.au. If we head across to WA, there is some rent relief for people who have lost their job on or after March 20 due to COVID-19. The grant pays up to $2,000, covering 4 weeks worth of rental expenses for those who were paying at least 25% of their rent or 25% of their income in rent, and have got less than $10,000 in personal savings. Now, the WA government has stated that personal savings refers to total amount in bank accounts, and that the level of rent is what was payable as at March 20 this year. Now, unusually under this scheme, it's the tenant that actually applies, but it's paid directly to the landlord. So JobSeeker recipients, they are ineligible, I'm afraid, because they're not technically employed, so they don't qualify under this particular scheme. If you do have clients that may be eligible, applications are open until September 29. And like we saw with the Queensland example, this is very much a first in, best dressed approach. So there is only a state government allocation of about $30 million for this scheme. So once it's exhausted, it's no longer available. So best to act quickly. And if you want to jump on that, the website for that is commerce.wa.gov.au, and just search for Rent Relief Grant. If we look for our 2 territories, starting with the ACT, similar to New South Wales, there is a land tax and rates rebate for landlords, which is available, and it applies to those who reduce rent for tenants by at least 25%. The rebate is 50% of the rent reduction and is capped to about $100 a week. So this scheme will extend for up to 6 months, so likely to end around October of this year. And finally, for Northern Territory, Territorians can apply for a complete abolition of payroll tax for 6 months. And this applies to small and medium-sized businesses, with large businesses only able to apply for a deferral in their payroll tax. But all businesses can apply for utility bill relief, and this grants a 50% reduction for 6 months to things like power, sewage, and water bills. Businesses with less than $50 million turnover, they need to have experienced a reduction of turnover of more than 30% to qualify. So hopefully some of those state and territory-based initiatives might be of use. If we step now back into some of the federal the federal measures, I should say, the Home Builder Initiative is one I wanted to cover off. And this was introduced back in June as a way to really help stimulate the residential construction market. And as you may be aware, it is a $25,000 grant to help build a new home, substantially renovate an existing unoccupied home, and there's a few other things that you can actually do with it, which is good. It will work in conjunction with existing first homeowner schemes and concessions. This does include the First Home Super Saver Scheme, it's called. Now, if you're assisting clients in accessing this benefit, applications, while it's provided by the government, applications are not made at a federal level. So what clients will need to do is actually reach out at a state and territory level to the relevant revenue office in that particular state or territory. So if you're in Victoria, it's through the State Revenue Office. In New South Wales, it's Revenue New South Wales. Queensland, it's their state-based Office of State Revenue, just to sort of point that out. There are some other eligibility requirements, and these include an income test that you can see here on the bottom of the screen, and the applicant must be neither a company nor a trust. They must be an actual person. It is provided tax-free, which is good in the hands of the applicant. So if building a new home or buying a new home off the plan, there is a cap that applies, and it's $750,000, and it applies to the combined house and land value. But if you're renovating an existing property, the substantial renovation requirement, the minimum spend is $150,000, but with that same cap of $750,000. But the property value prior to the renovations must be no more than $1.5 million. The contract for work needs to have been entered into from June 4 up until the end of this year, and the construction of off-the-plan purchases must not have commenced prior to June 4, so that same date. Now, an important advice consideration here is that clients won't be able to have the grant pre-approved, so it really is recommended that clients who are considering the home builder grant be able to fully afford the cost of the renovations or home purchase. Now, really the reason for this is that clients who are looking at, say, the substantial renovation option, the payment of the grant won't happen until at least $150,000 of payments have been made. For new home builds, the grant is likely to occur after the first progress payment. And for purchases off the plan, home builder is not likely until the applicant's name is actually registered on the title. So this could generate some interest from many of your clients and customers, including those of a mature age. So it may be worth looking at how this actually works. And I think from a mature age perspective, it could be well worthwhile for people maybe looking to improve their asset test position. So renovations that improve accessibility, safety, or livability of a home, they're fine. Investment properties, though, are not. They don't qualify. Structures that are standalone, things like swimming pools, sheds, standalone garages, they are not acceptable, I'm afraid. Owner builders are also not eligible for the scheme. Now, where it does get a bit tricky is that there can be certain situations where it's a little bit outside the box. So someone's not necessarily adding a second floor to a home, or buying a new house and land package. So I thought we'd have a look at just in case you get these kind of queries from your clients. So if you have a client that wants to do a knockdown and rebuild, what cap applies? Is this even allowed? There is some good news here. So knockdown and rebuilds are allowed. They are considered a substantial renovation. So the cap of $750,000 applies, and the value of the existing house and land package before the work being done needs to be no more than $1.5 million. What about the next one down? So what about land only? Well, if the land is purchased after the announcement and the home is built later on, the total value of the land and the new property being built must be no more than $750,000 to be eligible for the grant. If you've got clients that already own the land, so prior to the announcement, and they are deciding to later to build the home, the same rule applies here. So the combined value of the land and the build can't exceed that $750,000. For clients that already have some construction underway prior to June, regrettably, they miss out on the home builder grant. If you've got clients that have investment properties currently, but they are planning on moving in, there is actually an advice opportunity here, folks. So if your client moves in immediately after the renovations are completed, they may get access to the home builder as long as the other criteria like the income test have been satisfied. But what about the reverse? If it's a client's residential home now, but once renovations are complete, they'll move out and say make it a rental. This is actually not good news. So they will be ineligible for the grant unless the home itself is lived in for a minimum of 6 months after the renovations are complete. Then they'll be able to access the grant. And the final rule I want to touch off relates to those looking to sell the home after the renovations. The same occupancy rule applies. So the house has to be lived in for 6 months, and then the client is free to sell the home after that point. So I thought I'd finish off here just looking at some of the changes with the superannuation measures. Now, the temporary access to super scheme, look, I mean, it's been incredibly popular to say the least. In fact, if you've missed the APRA data that was released just yesterday, there's now been just over $30 billion in payments made from super across 3 million applications. It's just been phenomenal. And in fact, since July, there's already been 1.1 million repeat applications been received. So it's just been significant to say the least. The window of opportunity for accessing the super, look, it initially ran for 6 months, with the first period commencing, I think it was April 20 through to June 30, the second through to September 24. This has now been extended to the end of the year, but it's important to note that this extension is just for the second window only. It doesn't open a third window, in case clients are wondering. So applicants still limited to $20,000. The other thing that's probably important to reiterate here is only one application can be made per financial year. So if you have a client that's put in an application, applied for and received a benefit of say $7,000 in July, if they now want to get a top up of $3,000, that window's closed. The application has to be done in a single application, even if the money's spread across multiple super funds. Just a reminder here, folks, too, that if you've got clients who are eligible temporary visa holders, they actually don't get access to the second window. So they could get a single release of just $10,000 prior to July. They don't get a second shot for the 2021 financial year. So I just wanted to make that point in case you've got clients who are temporary visa holders. If you do have clients that are still suffering financially from COVID-19, there are another number of other options that are available. So this can include superannuation. So things like compassionate grounds. And it's not just for the super fund members here, folks, but also for a member's dependent, for a spouse or child, even those in an interdependent relationship. So if people are providing, personal, financial, or domestic support, while they don't get the same kind of tax friendliness, as you like, if you like, with the COVID-19, there could still be a window of opportunity there. And equally for severe financial hardship. So this could be another option, particularly for those that have been on government income support for at least 26 weeks, and they're just struggling to meet their reasonable and immediate family member expenses. So that's certainly something that could be noteworthy. But I think whenever we consider, as you'd well appreciate, any time we're accessing super, there can be some significant consequences. And I'm not just talking about the depletion of their super balance, but things like the potential loss of insurance benefits. As we sort of talked about, I think in the first session, a super fund could mandate a minimum balance, and it could be very different across different benefits within the fund. So there could be a minimum balance requirement for life and total and permanent disability insurance, and there could be a separate minimum balance for income protection. And there can be alternate considerations. So, one lot of insurance cover might require regular on-time employer contributions and another may not. And this could all be within the one super fund. So it really can be somewhat of a minefield, and I think a real opportunity to extend the advice around the COVID side of things, even into the superannuation, just to make sure that the clients don't inadvertently or perhaps unexpectedly lose access to many of these benefits. So folks, we've covered a lot of different initiatives today, and we've again put together some support materials for your use. We had some really strong feedback on these last time, and we wanted to make sure that these were refreshed and updated and made available for you. So we've included, as you can see here, the JobKeeper payment extension fact sheets. We've got advisor-friendly and also customer-friendly versions. So if you are interested, feel free to get access to these. We've also got up-to-date investment and economic updates, and these are available in the Zurich Advisor Portal. So 2 recent articles discuss the economic impacts and the recovery from COVID-19, and this was done by our own head of savings and investments, Matt Drennan. And in fact, in one, he accurately predicted an extension in the JobKeeper payment and that it wouldn't be in its current form. And this was back on July 7, so it was about a fortnight before the PM's announcement. So it was quite good insight there from Matt. Now, of course, if you want to know more, please reach out to your Zurich or your OnePath representative. And if you like this style of information, of course, if you head to zoneeducation.com.au, we do have a large library of CPD content available there across not just the sort of technical stuff we've covered today, but general interest, mental well-being, financial advice insights, much, much more. So look, I do hope this has been a real value add and investment of your time. And I'll hand back now to you, Rob, just to close off the session. So thank you.
Thank you, Adam. Congratulations. You have covered a lot of territory in that 45 minutes. We've just got a couple of questions. I am conscious of time, but there are a couple of questions and they've been repeated a couple of times. So I wouldn't mind if you could cover them off. The JobSeeker asset test reinstatement details. Would you be able to summarise those? We've probably had 2 or 3 questions with regard to the asset test for JobSeeker.
Yes. So with regards to the asset testing, so it's one of those areas which has been is being impacted, is being changed. So what we're tending to find is the liquid assets waiting period and the means testing will be reinstated. So this is going to apply to both new and existing recipients. So I think part of the issue here will be particularly around the instatement of the liquid assets waiting period. So one of the findings that we've found from the government release has been that not a lot of people are necessarily utilising some of their incentives for, I don't know, debt reduction or cost of living expenses, and are actually saving, actually banking it. And one of the fallouts of this is that, you know, if it's literally sitting in a bank account, once these changes come, go live, then whatever value is sitting in there, I think the division factor is like 500, and that then works out to 1 additional week up to a maximum, I think, of about 13 weeks. So suddenly you may find that there's this, liquid assets waiting period because of the asset testing, which has actually been altered as part of the change. So I think that's a real important call out there. And if you've got clients that are really looking to maximize that asset test threshold, some of the home builder stuff we looked at, some of the gifting provisions might work out for you, ways in which you can quite legally and effectively help to reduce the asset test threshold for many clients that may otherwise find that not only have their benefits actually dropped significantly, but actually may stop. But keeping in mind that the government has called out and said, look, if people do lose out from many of these income support measures, that they are not going to be letting go of those concession cards. So look, I know it's probably not the same as having money flow through to a bank account, but to be honest with you, many of these things, they do quantify. When you look at the amount of discounts and things you can get from hanging onto these cards, they can be, thousands of dollars over the course of a year.
Yeah, they're significant. And just one final one whilst it's here, and I think it's a related one about the alternative tests for revenue. Have they been removed? I don't know what alternative tests they would be, but
yeah, I'm not sure. I know there was the 1 week waiting period, and that was just a standard waiting period that they used to apply. The government has specifically called out and said that will not be affected by the change. Well, at least up until the end of the calendar year. So there has been a bit of a splitting, but it's a bit like they're starting to reintroduce some of the testing mechanisms, but not necessarily all in one great chunk. But a lot of these are changing as we speak. So it is quite possible that after today, that there could be some further changes to many of these. But certainly at this point, some of the other ancillary ones are likely to to be held off at least at this stage at the end of the year.
I think you can take that to the bank that things will change. Adam, congratulations. You've covered all the eligibility. You've looked at the various timeframes and the benefits. Appreciate the work that you've done in forensically, frankly, looking at the job seeker and keeper changes and what they mean for us in the advice profession. What particularly resonated with me, and thank you for putting this piece of work together, the benefits that sit in each state. So I don't think people would be frankly aware of those different benefits, whether it's some type of land tax relief or payroll tax relief, etc., which impacts businesses and individuals, and also for taking the time to put together that piece around a home builder. Folks, all of this material will be online at the AFA site. Adam did call out, most importantly, it's certainly with your Zurich representative, so make sure you reach out. Clearly, there's a catalogue of high quality information which can be repurposed directly to clients and consumers. Adam, I'd like to thank you personally. The second time that we've worked very closely together. I appreciate the length of time and the amount of time that you've put in to making this work. To the broader One Path in Zurich team as well for dedicating the time to share this with our members. I appreciate it. To the audience out there, thank you so much. Thanks for participating and hanging in. I know I'm a minute overdue, but once again, thank you. Your CPD certificate will be on its way out. Thank you again to the team at the AFA for helping put this together. I wish you all a very good afternoon.
Thanks, Rob. Thanks, everyone.
Thank you.